It's time now for our ETF Spotlight, and today we've got our eyes on energy, the worst performing sector of October and year to date. And today it's the biggest gainer on the S&P. That's despite a mixed earnings picture from Exxon and Chevron. Joining us with more is Stewart Glickman, CFRA energy equity analyst. For Chevron, he has a buy rating with a $133 price target. For Exxon, he has a hold rating with a $73 price target. Stewart, thanks for being with us today. Given the fact that we got results from two of the very biggest integrated oil companies in the world, your takeaway on those numbers?
Yeah, good morning. Thanks for having me. So I think that, if you look at the numbers, both companies beat fairly muted expectations. There was a lot of year-over-year deterioration across the board. It wasn't just upstream; it was also downstream, and in the case of Exxon, it was also chemicals. So, if you just look at the numbers, quarter on quarter, there's a lot of problems that the industry is facing, a lot of headwinds. However, that being said, both companies look like they're certainly investing for growth. I like Chevron's growth potential a little bit better, and I'm sorry, say again.
So, Stewart, taking a look, you look back at a year ago, and oil was in the 70s. Today, it's in the 50s. Where does it go from here, and what does that mean for energy stocks overall, more broadly?
Yeah, I think the outlook for oil prices is pretty mediocre. I think if you argued for something in the high 50s to low 60s range, I think that seems reasonable to me, just because there's an awful lot of supply still out there, and global demand is being buffeted back and forth depending on what the trade discussions are like of the day. I think the biggest thing that these companies have going for them, but Chevron particularly, is their Permian exposure is very strong. They have an awful lot of they can harvest a lot of the fruits of the stuff they've done in Australia with Gorgon and Wheatstone on LNG projects. And I think, historically, Chevron has always been trading at a fairly substantial gap to Exxon, and I think that gap is getting closed.
So looking across the sector more broadly, whether it's the producers, the oil and gas producers, whether it's the oil field services companies, or whether it's the refiners right now, or of course these integrateds like Exxon and Chevron that we just talked about, where do you see value? Where should investors be considering making an investment?
I think you have to be kind of picky. Within upstream, I think the names that don't depend on high oil prices are probably better bets. So a name like EOG Resources, which I would consider kind of best of breed among the E&Ps. I think they've been focused on premium wells before anyone else was. I think that's a good bet. I like, as kind of a contrarian play, I like Cabot Oil and Gas on the gas side because they have such a low-cost leadership position there. And then if you look among some of the downstream names, a lot of the downstream operations are going to benefit from the looming change in marine fuel sulfur regulations that hit on January 1st. That should really do a lot to help boost refining margins. So names like a Valero or a Holly Frontier especially should do well. Holly Frontier, inland refineries, and have pretty good exposure to Canadian crude that I think is going to come under a lot of pressure.
Okay. All right. Stewart Glickman, thanks for joining us today.
Thank you.